How does a life insurance suicide clause interact with incontestability? Imagine buying a life insurance policy and wondering what happens if the insured person dies by suicide. It's a question many people have when choosing coverage. Let's break down how the suicide clause and the incontestability clause work together in a policy. A life insurance suicide clause is a feature that prevents the insurer from paying out if the insured dies by suicide within a certain period after the policy starts. Usually, this period lasts for the first 2 years. If the insured dies by suicide during this time, the insurer can deny the claim and often refund the premiums paid. After this period ends, the suicide clause no longer applies, and the policy treats suicide the same as any other cause of death. The incontestability clause is another key feature. It limits the insurer's ability to challenge or deny a claim after a specific time, typically 2 years from the policy issue date. Once this period passes, the insurer cannot contest the validity of the policy based on errors or misstatements in the application, except in cases of outright fraud. Now, here is where the interaction becomes interesting. The suicide clause's exclusion period generally overlaps with the contestability period. This means that if the insured dies by suicide within the first 2 years, the insurer can deny the claim based on the suicide clause. The insurer can also contest the policy if there are misrepresentations, but only within this initial period. Once the contestability period ends, the insurer cannot deny the claim based on application errors. At this point, the suicide clause no longer prevents payout if the death is by suicide. The insurer must pay the death benefit, regardless of whether the death was by suicide or another cause. In practical terms, during the first 2 years, if the insured dies by suicide, the insurer generally will not pay the death benefit but might refund premiums. After the 2-year mark, the insurer cannot deny the claim due to the suicide, and the beneficiaries will typically receive the payout. This setup helps protect insurers from people purchasing policies with the intent of committing suicide early to secure a payout. It also gives beneficiaries peace of mind after the initial period, knowing that the policy will pay out if the insured dies by suicide later on. Remember, laws and specific policy terms can affect how long these periods last and how they interact. Some states might have different rules, and policies can vary. Always review your policy details or talk to an insurance agent to understand exactly how these clauses work together. Knowing this helps you see when a death by suicide will be covered and when it might be excluded, making your coverage clearer and more reliable.